Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
Today we're diving into three major stories. First up, a bombshell projection from Deutsche Bank about what could happen if Federal Reserve Chair Jerome Powell is ousted. We're talking a potential 6% tumble for the US dollar and a massive shock to Treasury yields. Then we'll turn to Intel, where the new CEO, Lip-Bu Tan, is declaring no more blank checks. He's cancelling huge factory projects even after a staggering $2.9 billion loss. And he's taking personal control of every single chip design. And finally, the art market, where a 300-year-old rule has officially been broken. We'll explore why sales at Sotheby's and Christie's have plunged 44% and how a new generation is redefining what it even means to be a collector. A bombshell projection from Deutsche Bank has the finance world on edge today, and it revolves around a single explosive question. What happens if Federal Reserve Chair Jerome Powell is forced out? Investors are now stress testing a scenario once considered unthinkable, the premature ousting of the Fed chief. Such a move would be seen as a direct assault on the independence of the central bank, and the potential fallout is staggering. So the thing is, this isn't just political drama. It's a direct challenge to the law. The Federal Reserve Act specifically states that a president can only remove a Fed board member, including the chair, for cause. Now, for cause has always been interpreted to mean serious misconduct, not simply disagreeing on interest rates. This is the legal shield designed to protect our monetary policy from short-term political whims. And there's historical precedent for this kind of pressure. Back in 1948, President Truman didn't fire Fed Chair Mariner Eccles, but he did demote him, which just shows how tense these standoffs can get. A direct firing would be a step into completely uncharted and dangerous territory. Beyond the dollar's potential historic drop, Deutsche Bank estimates the 10-year Treasury yield could jump 20 basis points, with the 30-year soaring 45 basis points. And while stocks might eventually like a more rate-friendly Fed chair, the initial shock would likely trigger a sharp sell-off. One analyst warns the drop would be far more extreme than recent market jitters. To understand why the drop could be so extreme, you have to look at what's happening behind the curtain. Modern markets are driven by high-frequency trading algorithms that scan news and social media for sentiment. Research shows that political tweets criticizing the Fed have caused immediate, measurable drops in market expectations for future interest rates. We're talking about automated systems creating feedback loops that can amplify volatility far beyond a rational human response. This is why a single political move could trigger such a disproportionately massive and rapid shock. This isn't just about one man's job. As one chief investment officer put it, financial markets have sent clear warning signals about the consequences of political interference. A forced exit or even a resignation raises fears of a politically compliant Fed, which could trigger, quote, severe and lasting market disruptions across multiple asset classes. This has investors eyeing safe havens. Gold, already near record highs around $3,400 an ounce, could leap even higher. But that's not the whole picture. The real fallout could be how this crisis of confidence might ignite the global race for the future of money. It could supercharge rival projects like China's digital yuan, which has already processed transactions worth nearly $1 trillion. It could also boost private, decentralized cryptocurrencies as people look for alternatives outside of government control. Even a less dramatic scenario, like nominating a successor months early, could create a shadow Fed chair. This would mean two powerful voices offering clashing views on monetary policy, resolving widespread confusion. And, the damage isn't just confined to the markets. A political takeover of the Fed could create a brain drain. Top economists might refuse to work for an institution where their research and recommendations could be politically compromised. A survey of federal executives found that 44% already see political pressure as a major obstacle. This could degrade the quality of the Fed's analysis for years to come. It all begs the question, once public trust in the Fed's independence is damaged, can it ever be fully restored? As one chief market strategist at Nationwide bluntly stated, it's really hard to put the toothpaste back in the tube. Speaking of American giants under pressure, let's shift from central banking to the heart of the tech world, where another titan, Intel, is facing its own existential crisis. The new CEO just took a blowtorch to the company's spending, declaring to the world there are no more blank checks. In a stunning move, the chip giant is cancelling massive factory projects in Germany and Poland and hitting the brakes on its cutting-edge Ohio facility. And what makes this timing so remarkable is that it comes just as Western governments are pouring billions into subsidies like the CHIPS Act, begging companies like Intel to build these factories to secure semiconductor supply chains. This move sends a chilling message. Even billions in government cash might not be enough to overcome brutal market forces and the immense cost of building these plants in the West. This comes as the company reveals it has already completed layoffs for 15% of its entire workforce. On top of all that, while Intel managed to beat revenue expectations, it still posted a net loss that has Wall Street reeling a staggering $2.9 billion for the quarter. To put that number in perspective, a huge chunk of that loss comes from a massive $3.1 billion write-down on manufacturing equipment. These are assets mostly tied to what's called the Intel 7 process node. This essentially means the company is admitting that billions of dollars worth of high-tech tools are now considered obsolete, a graveyard of technology representing a major R&D dead end. The source of the bleeding? A Foundry business that lost over $3 billion on just $4.4 billion in revenue. Now, get this. For a Foundry business like this to succeed, it needs to land a massive anchor customer, think a company like Apple or Nvidia. But convincing a direct competitor or a company loyal to the current king, TSMC, to bet their entire future on Intel's unproven process is an immense technical and financial hurdle. The new CEO, Lip-Bu Tan, didn't mince words, stating the company invested too much too soon without adequate demand. In an unprecedented step, Tan announced he will now personally review and approve every single chip design before it gets made, seizing direct control in a way few modern CEOs do. This is where the situation takes a more complex turn. This isn't just about saving money. It's a radical attempt to fix what many see as a broken internal engineering culture that led to past manufacturing mistakes. By centralizing power, the CEO is trying to get the ship turned around fast. The risk, of course, is that this level of micromanagement could create a huge bottleneck, stifling the very innovation Intel needs to survive. This entire corporate overhaul is a high-stakes gamble to regain market share from its longtime rival, Advanced Micro Devices, which has been steadily winning over key customers. The message from the top is brutally clear. The era of unrestrained spending at Intel is officially over. The question facing investors is whether this painful top-down restructuring is the shock therapy needed to save a titan or a sign of a giant in deep, deep trouble. Intel's story is a dramatic example of a single company trying to fix a broken model. But now, let's zoom out to an entire industry where a 300-year-old rule has just been shattered. For 300 years, one rule has dominated the art market. When the rich get richer, art prices soar. Today, that rule is officially broken. While the wealthiest Americans have added a staggering $37 trillion to their net worth since the pandemic, the fine art auction market is in a freefall. Sales at top houses like Sotheby's and Christie's have cratered, plunging 44% from their 2022 peak. That's a $3 billion collapse. The engine of the market, post-war and contemporary art, is down an even sharper 19%. The situation presents a fascinating duality that experts are calling the barbell market. Imagine a barbell with heavy weights on each end, but a thin bar in the middle. On one end, you have the ultra high-end $10 million plus paintings, and that part is collapsing. But on the other end, the market for art under $50,000 is actually booming. The middle is getting squeezed out, which puts a ton of pressure on mid-career artists and the galleries that support them. Experts are asking if this is just a dip or a fundamental crisis. A Yale professor who studied the market for centuries says the historic correlation between wealth and art is shattered. However, if you zoom out, you'll see the reason for this disconnect goes deeper than just changing tastes. For this new generation of investors, traditional fine art is starting to look like an inefficient and illiquid asset. Think about it. Research from Stanford's Graduate School of Business shows the true annual return on art is around 6.5%, which is often lower and riskier than what you could get from tech stocks or private equity. If you need to sell a painting, it can take months and cost a fortune in fees. If you need to sell a stock, you just tap a button on your phone. So, what's driving this? The core conflict appears to be generational. Baby boomer collectors are downsizing, but their millennial and Gen Z kids don't want the art. Interestingly enough, the new generation of wealth isn't just sitting on its cash, they're just spending it differently. And that shift redefines what collecting even means. We're talking about new status symbols. Instead of a painting on the wall, they want luxury watches, collectible sneakers, or even digital art. These are assets that align with their values of authenticity, personalization, and even sustainability, especially in the pre-owned watch market, which is now valued at over $27 billion. While sales of paintings over $10 million have plunged 39%, the luxury category is exploding. Jewelry sales are up a stunning 68%. Christie's reports that a third of its winning bidders are now millennials or Gen Z, and a full 80% of its bids are coming in online. Believe it or not, this shift online is forcing the auction houses themselves into a massive technological revolution to chase this new audience. They are using data analytics and AI-driven recommendations to completely reshape the auction experience. Christie's even held an auction for art created entirely by AI called Augmented Intelligence that brought in over $700,000, with nearly half the bidders being millennials and Gen Z. Sotheby's is now accepting cryptocurrencies like Bitcoin and Ether. This is the algorithmic gavel in action. The old guard is being replaced by a new, digitally native collector who prefers bidding on a phone for watches, handbags, and diamonds. With over $100 trillion in wealth set to be inherited by this next generation, this isn't just a market correction. It's a structural earthquake, raising a killer question. Is the traditional art market going extinct?
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.